Welcome to this Nedbank Financial Markets educational series, proudly brought to you by our online share trading division. In this video, we will discuss various investment styles that you can use to trade the markets. Learning about the different investment styles is essential for every client, as this will equip you to make more informed personal trading and investing decisions. As a client, you want to make money. However, there is more to this than meets the eye. It is important that you should have a clear understanding of the types of styles available and the different markets associated with these before making any trading or investing decisions. Please note that this session is on both a beginner and intermediate level. Before we start, please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice, as it is provided for educational purposes only. Let us begin the session. Let's begin by discussing the different investment styles, after which you can decide which one is right for you. Whether it is active or passive, value or growth, it's important that you get familiar with an investing style. When you're ready to start investing money, remember there's no one-size-fits-all approach. The investment strategy or style that works best for you may not be what works for anyone else. When pursuing investment goals, it's essential to ask the right questions that will help you determine which path to take. Some of the things you need to establish are whether you are risk averse or a risk taker. Are you looking for long-term growth or immediate gains? And are you planning to be a do-it-yourself investor or invest through an advisor or a robo-advisor? If you can establish this, it will help you match your needs to a specific investing style. In the following slides, we will look at 8 different ways to invest. Let's start with the active trader. If you have a high tolerance for risk and keep a close eye on market trends and movements, then an active investing style might be right for you. Active investing is generally used by investors who are not as concerned with the long-term horizon as they are with present gains. Active investing seeks short-term profits using specific shares and market timing to try and outperform the market. A common pitfall with active investing is attempting to chase returns. One needs to be aware of and avoid risks like recency bias, which assumes that the recent performance of a share or investment will continue. The second style we'll look at is passive investing. A passive investing style may be the right style for you if you're more risk averse and do not want to stare at market screens all day. If you would like to invest your money with a long-term time horizon instead of trying to time the market like an active investor, then this strategy is for you. A passive investor creates portfolios that track a market-weighted index or portfolio. The tracking of the index will generally result in reduced risk due to diversification, as well as lower transaction costs due to low turnover. The third investment style we'll look at is growth. This style of investing focuses on shares of companies whose earnings are growing faster than most other shares and are expected to continue to grow. These shares are regularly referred to as overvalued and have a high price-to-earnings ratio. It's important to note that these shares generally pay low or no dividends, but have potential to make up with strong return performance. The next investment style we'll discuss is value. Value investors look for those shares that are out of favor or undervalued. This differs from growth investors who seek out overvalued shares. Undervalued shares are expected to rise, and value investors seek to buy them before they rise. Warren Buffett has popularized this investing style, and he argues the merits of purchasing equities for less than the intrinsic value based on the premise that they will deliver consistent returns in the future. The fifth style we'll look at is market capitalization. Market capitalization investing is for those investors who select shares based on the size of the company. Market capitalization, or CAP, is calculated as the number of shares outstanding multiplied by the price of the share. This investing style is split into 3 broad market cap categories. These are small cap shares, which are generally considered to be a riskier investment than large cap shares. While their returns may be higher, so is their volatility. Mid-cap shares have a medium market capitalization, while large-cap shares are those that have been around a much longer time and tend to be more stable. Many people use large-cap shares in their portfolio because of their dividends and stability. Number 6 is buy and hold. Falling under the umbrella of passive investing is the buy and hold investing style. An investor who is engaged in buy and hold investing will trade in their portfolio infrequently. They are mostly concerned with long-term growth. The idea behind buys and hold is that you buy a share while its price is still low to benefit from price appreciation over time. The next style we'll look at is indexing. Indexing is another popular form of passive investing. An investor creates a portfolio that mirrors the companies of a particular index. The portfolio generally will perform in line with an index. This type of investing is good for people that are more risk averse because of the diversification of the index. The costs, including transactional costs and taxes relating to managing these kinds of portfolio, are relatively low, in large part due to less turnover. The last style we'll look at is diversification. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. Systemic and unsystemic risk are the two kinds of risks that every investor must be concerned about. Systemic risk is a market risk that cannot be mitigated through diversification, but unsystemic risk, or the risk that comes from investing in one specific company or sector, can be reduced through diversification. So which investing style will you choose? The investing style that ultimately will work best for you will align to your risk tolerance, your time horizon for investing, your age, and your investment goals. There is no right or wrong investing style to pursue. Remember that your investing style is also not set in stone. As you grow older and your circumstances change, so will your investment objectives. You should regularly re-evaluate your investment style to ensure that it continues to be aligned with your current investment objectives. We have come to the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.